Ever since I started my full-time job, I found it incredibly challenging to keep up with the ongoing stock research. And that's why I rely heavily on stock screeners and my own expertise to choose the right criteria to quickly filter out for interesting opportunities. In this video, I'm going to share with you 5 stocks that have caught my attention recently. But before that, if you haven't done so, do join my free weekly newsletter where you will get tips on the US and Singapore stock markets, stock ideas, analyst reports, and many more. You can find the link down in the description box below. So without further ado, let's jump back to the video. So talking about the stock screener, I only have two very simple criteria. First, I look for stocks trading near the 52-week lows or 1-year low. This is because in the market that's on a recent decline, this helps me to limit my future losses. And then on the second criteria, I go for stocks with upside potential of over 20% according to analyst estimates. The reason also is very simple. I want the analysts to already do their homework for me so that I can dive in deeper to do my own research after what the analysts have already done. Okay, so these two criteria, so very polarizing. One is going 52-week lows, and the other one is upside potential. So it effectively means that I'm safeguarding my downside and aiming to maximize my upside potential. All right, so without further ado, let's jump into the first stock on my list. So talking about the stock screener, I only have two very simple criteria. First, I look stock on our list is none other than Adobe. I believe a lot of us have heard of Adobe before, Adobe Photoshop, especially in the creative industry. Those graphic designers, UI, UX designers will have used it before. Okay, so it's a very popular tool, and the share price has fallen by quite a bit. And instead of pulling out the share price chart, I decided to grab this price to earnings ratio chart, which really shows how last time is trading at 40 something 45 times price to earnings and declined I think more than 40% to trade at 25 times at the time of this video. And the reason why Adobe has fallen by so much is I believe the recent AI ramp up with so many AI tools being able to generate this kind of videos or photos very nicely done. A lot of investors are spooked, right? They feel that Adobe has no more value add anymore, and even the recent subscription pricing has spooked investors. AI integration comes at a one time huge cost, also impacted their profit margins. But when you look at all the analysts, right now they are still very quite bullish on Adobe, and I would say I'm also looking at Adobe at the moment because of its future outlook. You can see this news that Adobe is not just sitting on its laurels, it is already rolling out AI agents. It's like the next step of Gen AI. So AI agents is already being rolled out by Adobe for online marketing tools. They know, okay, that the people who are using Adobe are marketers, okay, those that are graphic designers plus marketers, and hence I believe it's a very smart move. They are rolling out AI agents for online marketing industries, okay, and on top of that, there are other tools like Firefly AI, Creative Cloud, Document Cloud are also looking at a very strong adoption rates, especially the Firefly one, where I put it over here, right? Is commercially safe, IP friendly, as compared to when you generate those kind of photos or videos from ChatGPT or even DeepSeek, those kind you can't really use it for your clients. But for Firefly AI, you can, and there's this seamless integration with the Creative Cloud ecosystem, which I feel is a really what you call that, the creative professionals will somewhat be know that it's safe to use and further um, be intertwined with the ecosystem in Adobe itself. Okay, so all in all, I for me it is a stock that is worth putting in on my watch list itself. To our second stock, Microsoft. To be honest, I'm pretty surprised that Microsoft is trading at a 1 year low, given that I haven't really looked at it because of the high P ratio. I do recall that it's around 40 times back then when I saw it, and right now it's trading at 31 times. So I decided to compare it with the other tech giants like Apple, Oracle, Facebook, and even Alphabet. Okay, so it's right smack at the middle at 31 times with expected earnings growth of 12%. Although it is not really cheap in a sense, given the caliber, given the everyone uses Microsoft in a one way or another, I do believe that it warrants a deeper look. Okay, so with that, okay, let's talk about why Microsoft stock has fallen by a bit. So first of all, of course, is the cloud growth deceleration, enterprise spending cuts, recession. Uh, maybe recession coming up, and people think that the cloud growth will decelerate. So it's really a short term kind of a thing. Okay, moving on, AI investment. So the Microsoft has invested heavily into AI infrastructure, same as Alphabet, same as Tesla, and all that. So has pressured the profit margins, but I do believe that the long term positioning remains very strong. On top of that, we have the gaming recovery. So Xbox hasn't really done so well because Xbox is like a very small portion or division for the whole Microsoft itself. But then you have Activision Blizzard integration proceeding well as well, and all the kind of other optionality that I do feel that Microsoft will propel Microsoft share price going forward. And especially when you talk about the Copilot, I do feel that once if they really integrate well, given that they have the subscription with Teams, with all the cloud-based offerings, and you have Copilot, a lot of enterprise clients will just okay, maybe we just integrate Copilots, help to enhance efficiency for our whole team and that kind of thing. This will really drive the revenue for Microsoft going forward. Stock on our list is Skechers. Okay, this is a shoe brand that is different. Okay, pretty different from the other shoe brands out there, like On Holdings, Nike, Deckers, and even Crocs. So let's talk about them, right? So Crocs, you know that it is, I would call them a shoe with holes, and it's not really. It's more for hipster youngsters, kind of a feel lah. That's to me, all right. And on the other hand, you have those kind of Nike, On Holdings, even Hoka. They are focused on performance running, like very high end. You want to do well, excel in the sports that you like. For example, basketball, you have basketball shoes. Soccer, you have soccer shoes, and that kind of thing, right? But for Skechers wise, if you think about it, right, and you take a look at all the Skechers outlets all over Singapore, you will notice one trend. They focus on comfort, and comfort is being prioritized by our usually lah our parents, and I myself are using Skechers. So my wife bought Skechers for both of us plus our kids. So it, in a way, if you're not really into those kind of sports, uh, what call it, active sports, right, and more just a leisure jogging kind of a thing, I think Skechers plays a very good ground in all that kind of thing, and this is the reason why I chosen this stock. And right now it's trading at 13 times price to earnings, quite cheap or affordable compared to like Nike is 22 times, even after the share price has declined by 50%. Or even On Holdings is a new brand, up and coming. Okay, like not really up and coming, but like it's trading at 50 something times, or even 4 times that of Skechers. And Crocs maybe is a different genre, lah, so I don't want to really mention about that. Okay, and why has Skechers come down to a 1 year low? Okay, there are a few reasons why. So first of all is the supply chain issues. This may be a temporary issue. I don't really think that it will impact them, uh, because if you have huge demand and you don't have enough supply, that's a good problem in the long term, lah, right? And margin pressure, Skechers always run discount promotions and that kind of thing. So if there are on top of that rising material costs, it will squeeze their profits. But as a regular customer of Skechers, I do see their prices increasing steadily over the years. So even though they like, oh, give you one for one, but it's calibrated lah. It's already going up, and then they give you discount. All right. But what I like about this is this brand or this company is their international expansion. So they used to come from the US, right? But you can see like in Singapore itself, in Asia markets itself, it's really growing their Asian market presence. So direct to consumer channels or even retail outlets are expanding rapidly. And on top of that, the last point is the athletic trend tailwinds. So this is what I call like at leisure. So at leisure is like you can go for athletics sports, at the same time you can go for leisure kind of walking and things like that. So this kind of comfort footwear demand remains very strong, especially when we talk about my grandparents, my parents generations. um, this is a really a target market that Skechers is really doing well in. Fourth stock on our list, CapitaLand Escort Trust. So I know that all the REITs and trusts in Singapore have fallen quite sharply due to the high interest rates, but CapitaLand Escort Trust is the only one where we have 5 analyst ratings and more than 20% potential upside. Okay, so I decided to pull this price to book ratio chart of CapitaLand Escort Trust, and I see that it is trading at around 0.7 times price to book ratio. This is the lowest it has gone apart from COVID, as seen from this 5 year chart, right? So 2020 is the one during COVID, it has gone down way below like 0.6 times. But 0.7 times is the second lowest it has gone so far in this 5 year period. And that is what makes it interesting, okay? So although the share price has come down, I mean, the prospects look bright enough. So first of all, we have this rising revenue per available room, right? It is actually trending upwards if you look at their investor relations presentation slides. Interest rates have hit a peak, okay, and is predicted to fall. So decreasing borrowing costs will improve productivity, will improve profitability, and hence give you more distributions. So in a way, like these two already benefit, right? And specific to Escort Trust itself, it has a strong lodging portfolio, especially with the CapitaLand branding, right? It has a lot of premium properties, and somewhat I do believe in the sponsor lah. So this also helps to lower the borrowing cost as well. And the last point is a global recovery. Okay, so this one is talking more about business travel or maybe consumer travel, not so much on the economic recovery lah. more on people are traveling. Hopefully, the tariffs by Donald Trump won't affect so much. But when people travel, people want to stay in lodging uh, properties like from Escort Trust. The last stock on our list is Marco Polo Marine, actually a small cap shipbuilding company, right? And the reason why I chose it is because of a few reasons. One is in the shipyard business, you know that right now it is a growing industry, and Marco Polo Marine is also moving into the clean energy space. And the last point, maybe I want to highlight is their low price to earnings ratio. Okay, so what I've done is to pull out two PE ratio charts. The one on the left is the trailing 12 months earnings PE ratio chart, whereas the one on the right is what based on what analysts predict a forward 12 months. So on the left, you can see that Marco Polo Marine is actually the second highest. It's more expensive than Yang Zhejiang, Penguin, Bangguang Marine. But on the right side, you can see that it is actually the lowest because analysts don't have any forward guidance for ASL Marine and Penguin. So it is other than Yang Zhejiang, Marco Polo Marine, and Bangguang Marine. Marco Polo Marine is trading at a forward 5.9 times price to earnings ratio. So it's considered one of the lowest. The reason is because of the earnings growth. You can see from the right hand side, right? The gray color one. It is expected to have a 16.6% earnings growth as compared to Yang Zhejiang 12.5%, Bangguan Marine actually a negative 2.5%. So this is how you can see, okay, or decipher which one is so-called cheap or not cheap based on this kind of trailing or forward ratios. And a few things to cover here, okay, about Marco Polo Marine. So first of all, like what I shared, right? This is a shipbuilding company benefiting from the oil and gas recovery. Right now, with Donald Trump coming in, I'm not really sure whether energy prices will increase again, but I do know that they want more offshore activities, more pumping of petrol and things like that. So even if the oil prices do not go up significantly, they are going to have a lot more, oil and gas activities. So all these activities will require more capex, more equipment, rental of ships from Marco Polo Marine, etc. Okay, so you will boil well for the company. Second point, fleet expansion. So on top of some boats, new boats coming in, there's one very zhong one, okay, which is the CSOV. So this is a very big ship that can be chartered to some client over a long period of time, and it's a very big ship that will be sent offshore, and it is set to be launched in second half this year. If I'm not wrong, it has already secured a client. So once that kickstarts, okay, the earnings are going to flow into the company coffers. And the third point is the clean energy pivot, which I already talked about. It is going into the offshore wind support operations. So, in Taiwan especially, there's a lot of offshore wind turbines that require servicing because they are like way off from the land. So we need a lot of the ships to do, just offshore services lah. And yeah, oh sorry, the last point is the crew transfer vessels. Three new vessels coming up, which will expand the capacity, similar to the new CSOV. So all these new ships, new revenue streams, better prospects for the company. All right, to sum up, okay, these five stocks are near 52-week lows. I purposely chosen them this way on top of the more than 20% analyst potential upside so that they give you a better risk to reward ratio. And These five stocks are chosen not based on any tech sector, particular sector. So please choose your own the stock that you are familiar with, you would like to get started and do more due diligence on. So this is not a recommendation. Please do your own homework, okay? And if you find this video helpful, please like, comment, and subscribe to my YouTube channel for more insights like this. Thanks for watching, and we'll see you in the next video.